I never know what markets are going to do. There's never been a time in my life when I know what markets are going to do over a long period of time. They're going to go up.
Many great investors tend to push the same rhetoric. Over time, stocks are going to go up. And historically, they're right. Since 1978, there has never been a point in time at which if you had bought the S&P 500, 20 years later, you'd still be down. Had you bought the S&P at its peak in 2000 or 2007, you would still be up if you had held just 15 years. But that's if you buy at the peaks. What if you buy during the recession, where prices are lower? The best way to build generational wealth in a safe and guaranteed way during a recession is by dollar cost averaging. Dollar cost averaging, or DCA for short, is an investment strategy in which an investor divides the total amount to be invested across periodic purchases of a target asset in an effort to reduce the impact of volatility on the overall purchase. In more simple terms, dollar cost averaging is buying an asset in increments instead of buying all in one go. Let's put this in terms of a real-world example. If you had invested $1,000 in October of 2008, it would have taken you over 9 years to finally double your money. On the other hand, if you had spread out this money over a year, investing instead $83.33 every month, it would have only taken you 6 years. This is because your average cost per share was lower. In October of 2008, your $1,000 investment would have gotten you 7.73 shares of SPY. Our dollar cost averaging strategy would have gotten you 10.19 shares of SPY, so you simply own more of the underlying asset, and as its price increases, you will see greater returns. Here we looked at the S&P, but dollar cost averaging can be used on anything from individual stocks to Bitcoin. I'll confess that this example is cherry-picked, and there are many other examples in which dollar cost averaging wouldn't have been as beneficial. But this example serves to prove a point, which is that dollar cost averaging can substantially lessen the blow of a market downturn. No one knows where the bottom is, so it's important to buy on the way down and on the way up so that you can own as much of the underlying asset as possible while still remaining risk adverse. Real quick, smash that like button so I can see at least one number going up, because my portfolio definitely isn't going up right now. Another way to safely profit during a recession is through stable investments. The most stable investment is cash or cash equivalents, as you know that $1 will always be worth $1, even if inflation makes that dollar less powerful. Other than for emergency funds and deal hunting on investments, it's never good to hold on to too much cash. The least you could do is put it in a high-yield savings account like Ally Bank, Capital One, or Marcus by Goldman Sachs and earn 1% APY. You could also buy bonds, which will only become better deals as the Fed continues to increase rates. At the time of this recording, 2-year Treasury notes are returning 3.1%, which is a massive increase from last year's low of almost 0.1%. Other than regular bonds, there's I-bonds, whose interest rate is based on current inflation. Currently, with inflation so high, I-bonds are returning 9.62% APY while being backed by the US government. I made a 6-minute comprehensive guide on I-bonds covering everything you need to know from what they are, how they work, to how to buy them. Check it out.